$145 trillion in global derivatives exposure is triggering the largest forced liquidation event in financial history. Not voluntary selling, not strategic repositioning, not profit-taking. Forced selling, where institutions must liquidate positions immediately regardless of price. To meet margin requirements, they cannot cover with available cash. This is the $145 trillion margin call. And everything must be sold now. Let me show you exactly how this forced liquidation cascade operates. Let me walk you through the leverage mathematics that make this selling wave mathematically unstoppable. And let me explain why this represents systematic deleveraging that will destroy asset prices across every major financial market simultaneously. Because when you understand the derivative exposure, when you see the margin requirements, when you recognize the forced selling mechanics, you realize this is not market volatility. This is systematic liquidation, where mathematical requirements override market fundamentals and force asset sales at any price. The margin call is not theoretical. The margin call is mathematical inevitability. Every leverage crisis in history followed identical patterns. Excessive borrowing against asset collateral during low volatility periods. Leverage ratios exceeding prudent risk management during favorable market conditions. Sudden volatility spikes requiring immediate additional collateral. Forced liquidation cascades destroying asset values and triggering additional margin calls. The current situation represents this pattern at unprecedented global scale through interconnected derivative markets that exceed world GDP by more than 4-to-1 while operating with minimal collateral requirements during normal market conditions. Global derivatives exposure totals $145 trillion across interest rate swaps, credit default swaps, foreign exchange derivatives, commodity derivatives, and equity derivatives that create leverage positions requiring continuous collateral maintenance. Interest rate derivatives represent the largest component at approximately $75 trillion notional value through swaps that exchange fixed rate payments for floating rate payments. Rising interest rates increase margin requirements exponentially as position values fluctuate beyond predetermined ranges. The mathematical impact becomes clear through simple calculation. A 2% interest rate movement on $75 trillion creates $1.5 trillion in mark-to-market losses that require immediate collateral posting or position liquidation. Federal Reserve rate increases from 0.25% to 5.33% represent 5% movement that creates $7.5 trillion in theoretical losses across interest rate derivative markets, requiring immediate margin posting. But available collateral cannot cover $7.5 trillion in margin requirements because global banking system capital totals approximately $3 trillion, while many derivative positions lack adequate collateral backing during normal market operations. The forced liquidation begins when margin calls exceed available collateral, forcing institutions to sell liquid assets, including stocks, bonds, real estate securities, and commodity positions to raise cash for margin requirements. Pension funds represent the largest forced sellers with $3.4 trillion in bond liquidation requirements over the past 6 months as rising interest rates destroyed bond values while increasing margin requirements on derivative hedging positions. California Public Employees Retirement System liquidated $120 billion in bonds during third quarter alone, while continuing to sell government and corporate securities to meet derivative margin requirements that exceed available cash reserves. European pension funds face similar pressure with $2.1 trillion in required bond sales, as European central bank rate increases triggered margin calls on interest rate hedging strategies that assume permanently low rates. Hedge fund deleveraging represents the second wave of forced selling, with $890 billion in position liquidation during the current week, as prime brokerage margin requirements increased across multiple asset classes simultaneously. Bridgewater Associates liquidated $45 billion in positions during September, while Renaissance Technologies closed $38 billion in quantitative strategies, unable to meet increased margin requirements during volatility spikes. 2 Sigma, AQR Capital, and other systematic trading funds face similar liquidation pressure as algorithmic strategies require continuous leverage that becomes impossible to maintain when margin requirements exceed available capital resources. The cryptocurrency lending collapse creates additional forced selling through $300 billion in liquidated positions, as BlockFi, Genesis, FTX, and other platforms face insolvency requiring immediate asset liquidation to meet creditor obligations. Japanese carry trade unwinding represents systematic risk through $2.8 trillion in positions where investors borrowed yen at low rates to purchase higher yielding assets globally. Rising Japanese interest rates eliminate carry trade profitability while creating margin calls. Bank of Japan policy changes triggered carry trade liquidation affecting global equity markets, emerging market bonds, real estate investment trusts, and commodity investments funded through yen borrowing strategies. The unwinding accelerates as yen appreciation creates currency losses on top of underlying asset volatility, while margin requirements increase exponentially during systematic liquidation periods affecting multiple markets simultaneously. Credit default swap markets face additional stress through $45 trillion in notional exposure, where protection buyers face margin calls as credit spreads widen beyond predetermined ranges, requiring immediate collateral posting. Corporate bond defaults increase margin requirements for credit protection sellers, while economic stress creates additional volatility requiring larger collateral buffers across interconnected credit derivative markets. Foreign exchange derivative markets create forced selling pressure through $38 trillion in currency hedging positions, requiring constant collateral maintenance as exchange rate volatility increases margin requirements globally. Currency volatility accelerated during central bank policy divergence, where Federal Reserve rate increases strengthened the dollar while creating margin calls on foreign exchange positions across international financial institutions. Commodity derivative markets face liquidation pressure through $22 trillion in futures and options positions, requiring physical or financial settlement, while margin requirements increase during price volatility periods. Energy derivative liquidation affects oil, natural gas, and electricity markets, where hedge funds and trading companies face margin calls exceeding available collateral, requiring immediate position closure, regardless of fundamental supply-demand conditions. Agricultural derivative markets experience similar stress through grain, livestock, and soft commodity positions, where weather volatility and supply chain disruption create margin calls, forcing systematic liquidation across commodity trading firms. Real estate derivatives face particular stress through commercial mortgage-backed securities and real estate investment trust derivatives, where property value declines, increase margin requirements, while reducing available collateral values simultaneously. Commercial real estate liquidation accelerates as derivative positions require margin posting, while underlying property values decline, creating negative feedback loops where forced selling reduces collateral values, requiring additional selling. The forced liquidation mechanics operate through prime brokerage relationships, where banks extend credit against securities collateral, while maintaining legal rights to liquidate positions immediately when margin requirements exceed account values. Goldman Sachs, Morgan Stanley, and other prime brokers implement automated liquidation systems that sell positions instantly when margin calls trigger predetermined risk limits without client notification or approval during volatile market conditions. The liquidation timing creates systematic selling pressure during market stress when asset prices decline rapidly, while margin requirements increase simultaneously, creating maximum price impact from forced sales. Algorithmic liquidation accelerates selling pressure as computer systems execute predetermined risk management protocols, selling positions at market prices, regardless of impact on underlying asset values or market stability. High-frequency trading systems detect forced liquidation patterns and accelerate selling pressure through front-running strategies that anticipate additional forced sales, creating cascading price declines across affected markets. The collateral shortage becomes apparent when available assets cannot satisfy margin requirements, creating systematic liquidation affecting every major asset class simultaneously, while reducing overall market liquidity. Treasury bond liquidation increases yields while reducing bond prices, creating additional margin calls for fixed income derivative positions, requiring more treasury sales in self-reinforcing cycles. Equity market liquidation affects index futures, options markets, and exchange-traded funds where forced selling creates downward pressure across all equity sectors simultaneously regardless of individual company fundamentals. International contagion spreads liquidation pressure across global markets as margin calls in one jurisdiction trigger asset sales affecting correlated positions worldwide through interconnected derivative exposures. European banking stress creates forced selling affecting dollar-denominated assets, while Asian market liquidation impacts commodity markets and emerging market securities, creating global selling pressure. The regulatory response proves inadequate because forced liquidation operates through private contractual arrangements between counterparties, while regulatory authority cannot override margin requirements or prevent contractual liquidation rights. Central bank liquidity provision cannot address margin requirements because derivatives clear through private systems, while collateral posting requires actual asset transfers rather than central bank credit facilities. The systematic nature prevents market intervention because forced selling affects every major asset class simultaneously, while traditional stabilization mechanisms assume isolated market stress rather than comprehensive liquidation. The mathematical inevitability results from derivative exposure exceeding available collateral, while margin requirement calculations assume normal market conditions that no longer exist during systematic liquidation periods. The timeline acceleration occurs because forced selling creates additional volatility, requiring higher margin requirements, creating feedback loops where each liquidation wave triggers additional margin calls across interconnected positions. Market makers withdraw liquidity during forced liquidation periods, reducing market depth while increasing price impact from systematic selling, creating conditions where small sales trigger large price movements. The wealth destruction exceeds 40% across major asset classes, as forced selling eliminates price discovery mechanisms while creating systematic undervaluation during liquidation periods affecting pension funds, insurance companies, and individual investors. Retirement account losses exceed $2.7 trillion as equity and bond portfolios decline during forced liquidation, affecting worker retirement security while reducing future consumption capacity. Insurance company solvency faces pressure as investment portfolios decline, while derivative hedging positions require additional margin posting, creating systematic stress across insurance industry affecting policyholder security. Banking system stability depends on asset values that face systematic decline during forced liquidation, while derivative exposures create additional capital requirements exceeding available resources across regional banking systems. The credit contraction accelerates as forced liquidation reduces asset values serving as loan collateral while increasing bank capital requirements, reducing credit availability for businesses and consumers during economic stress. Economic recession becomes inevitable as forced liquidation reduces household wealth, corporate investment capacity, and government tax revenues, while increasing unemployment and business failures across all economic sectors. The deflationary spiral begins as forced selling reduces asset prices while debt obligations remain fixed at nominal values, increasing real debt burdens across households, businesses, and governments during systematic liquidation. International trade declines as forced liquidation affects exchange rates, commodity prices, and credit availability for trade financing, while reducing global demand for goods and services during recession. The recovery timeline extends years rather than months, because forced liquidation eliminates investment capacity, while debt deflation reduces consumption and business formation during extended deleveraging periods. Historical precedents suggest systematic liquidation events require complete deleveraging before recovery begins, while asset prices remain depressed until leverage ratios return to sustainable levels through forced selling completion. The mathematical conclusion becomes unavoidable through derivative exposure analysis and collateral requirement calculations that prove current positions cannot be maintained at current interest rate and volatility levels. The $145 trillion margin call represents systematic deleveraging that must continue until derivative exposures match available collateral resources or positions are eliminated through liquidation. Everything must be sold because mathematical requirements override market fundamentals, while forced liquidation operates according to contractual obligations rather than investment merit or economic analysis. The margin call cascade cannot be stopped through policy intervention because derivative liquidation operates through private contracts, while systematic selling creates volatility requiring additional margin posting across interconnected markets. This is not market correction. This is systematic liquidation. Everything must be sold now to meet margin requirements that exceed available collateral across $145 trillion in derivative exposures. The forced selling continues until leverage ratios decline to sustainable levels or derivative positions are eliminated through liquidation. Mathematical inevitability guarantees continued systematic selling regardless of asset values or economic impact. The $145 trillion margin call represents the unwinding of the largest leverage bubble in financial history. Everything must be sold. The mathematics demand it.